FVG, a fair value gap, occurs when there is an imbalance in price action on a price chart, typically seen in candlestick patterns. It represents a zone where price moves too quickly, leaving behind a gap between candles. This often happens due to high volatility, strong buying or selling pressure, or institutional trading activity. FVGs are commonly used in smart money concepts, SMC, and ICT, inner circle trader, trading strategies to identify areas where price is likely to return before continuing its trend. How to identify a fair value gap? Look for 3 consecutive candles. A fair value gap forms when the middle candle creates a large movement, leaving a visible gap between the wicks of the first and third candles. Check for a gap in price action if the low of the third candle is higher than the high of the first candle, bullish FVG, or if the high of the third candle is lower than the low of the first candle, bearish FVG, then the space between them is the fair value gap. Mark the zone. Draw a box covering the gap between the first and third candles' wicks. This area acts as a potential support or resistance level where price may return before resuming the trend. Bullish fair value gap, FVG, occurs in an uptrend. Price moves aggressively upward, creating a gap, acts as a potential demand zone where price might return before continuing upward. Bearish fair value gap, FVG, occurs in a downtrend. Price drops sharply, leaving a gap, acts as a potential supply zone where price may return before continuing down. Why do fair value gaps form? Institutional orders. Large financial institutions, banks, hedge funds, place large buy-sell orders that move price aggressively, leaving gaps. High volatility events, news releases, economic data, and major announcements can create rapid price movements, leaving imbalances. Liquidity voids. Market makers and smart money traders seek to fill these gaps to ensure proper liquidity before the next big move. How to use FVG in trading. Entry strategy. Wait for price to retest the FVG zone before entering a trade. Look for additional confirmations like support to resistance, order blocks, or RSI divergence. Exit strategy. Use FVG as a potential take-profit area if trading in the direction of the gap fill. Place stop losses slightly beyond the FVG zone to reduce risk. Confluence with other indicators. Order blocks. If an FVG aligns with a strong order block, it increases the probability of a reaction. Fibonacci levels. FVGs near key Fibonacci retracement levels, E61.8%, are more likely to hold. Divergences. RSI or MACD divergence near an FVG can indicate a strong reversal. Example of fair value gap in a chart. Spot a strong move. Identify a 3-candle structure where the second candle creates a large imbalance. Draw the FVG zone. Mark the gap between the first and third candles' wicks. Wait for price to fill the gap. When price returns to the FVG, look for entry signals. Trade in the direction of the trend. Once price reacts at the FVG, enter a trade with proper risk management. Fair value gap imbalance in 3-candle structure. High volatility or institutional moves. Liquidity gap. Large price movement with low liquidity. Fair value gaps typically indicate potential areas where the market will retrace to fill the gap, reflecting underlying market inefficiencies, whereas common gaps often occur in non-trending markets and are usually filled quickly without significant trading opportunities. Fair value gaps are powerful tools used by professional traders to spot imbalances. They act as magnetic zones where price is likely to return before continuing its trend. Always use FVGs with confluence indicators like order blocks, trend lines, and Fibonacci for higher accuracy. Risk management is key. Place stop losses beyond the FVG zone to avoid unnecessary losses.